So first of all, thanks for the invitation to present here at the KR conference. And I have to apologize to many of you because I just came out of the job market and you've seen my paper probably 5 days ago. All right, so this is my paper on customer-based concentration. And let me start by motivating the paper. Relationships with major customers are typically considered to be an impediment to supplier firm performance. The conventional view is that major customers pressure their dependent suppliers to provide price concessions, trade credit terms, and hold extra inventory. Now, the popular press often highlights the evils of concentration by reference to the case of Walmart and its history of squeezing out every last penny from its dependent suppliers. Now, to my view, this conventional view of customer-based concentration can be traced back to the ideas of Galbraith on relative bargaining power. So, in his book, American Capitalism, Galbraith, back in the 50s, I wasn't even born, he claimed that major customers place orders around which the production and investment of suppliers with concentrated customer bases becomes organized. Now, the threat or even the fear of sanctions is enough to provide major customers with considerable power over transaction prices and trade credit terms. Now, over time, an alternative view of customer-based concentration has evolved. Research in operations management and relationship marketing, in fact, proposes that efficiencies may accrue to suppliers with concentrated customer bases. Efficiencies due to collaborative advertising and marketing efforts and due to higher overall effectiveness of selling expenditures. A related research proposes that relationships with major customers accelerate the deployment of sophisticated procurement systems, such as just-in-time delivery, and enable information sharing and coordination along the supply chain, and giving the opportunity to suppliers to enhance inventory utilization and overall asset-based utilization. Now, in this paper, what I'm trying to do is find out empirically which one of the two views, the conventional or the alternative view, prevails in practice. Okay? So what I examine is whether and how customer-based structure affects supplier firm performance and stock market valuation. And to address my question, or to start addressing my question, I compile a comprehensive sample of more than 47,000 business-to-business links and introduce a firm year measure to capture the extent to which a supplier's customer base is more or less diversified. As you'll see in this paper, I'm using traditional capital market research tools to address, I think, a not so traditional accounting question. So here's what I find. So first of all, I document a positive contemporaneous association between the level of concentration, of customer-based concentration, and the level of supplier firm performance. In other words, suppliers with concentrated customer bases tend to be more profitable. Digging deeper into the performance components, I find that although suppliers with concentrated customer bases tend to report lower gross margins, they tend also to experience efficiencies that come in two forms. They tend to be better able to utilize their asset base, and they tend to spend less on SG&A per dollar of sales. As a result, they tend to be associated with higher asset turnover and higher profit margin, and overall they seem to be more profitable. Now, I'm going down the path of sort of trying to show a stronger association or trying to go down the path of establishing causality, and I find, consistent with the cause and effect relationship between customer-based structure and performance, I find that changes, the year-by-year changes in concentration, are significant leading indicators of subsequent changes in profitability components and overall firm performance. In particular, I find that increases in concentration are subsequently followed by efficiency gains in the form of reduced SG&A expenditure per dollar of sales and enhanced asset utilization. I also probe deeper into the capital market implications of customer-based dynamics, and I find that the market seems to understand the link between customer-based structure and performance. So what I find is that investors seem to be revising their beliefs and valuations consistent with the fundamental information embedding customer-based concentration changes, and they seem to perceive increases in concentration as good news for stock market valuation and decreases in concentration as bad news for stock market valuation. In additional analysis, I find that the market seems to be getting the link between concentration and performance, but with a time lag. The sample is based on the disclosure requirements set by the FASB and the SEC that supplier firms need to disclose information about their customer base. My sample includes more than 47,000 business-to-business links over the 30-year period from 1977 to 2006, and the sample is widely distributed across as many as 69 two-digit SIC codes. Now, the primary variable introduced in the paper is the measure of concentration, and attempts to capture for supplier firm I in year T the number, two dimensions of diversification. The first one is the number of major customers with which the supplier firm interacts, and the relative importance of each major customer in the firm's annual sales. So changes in concentration could be coming due to changes in the number of major customers of the supplier firm, or changes in the relative importance of each customer, of course, or changes in both dimensions. So first, I look at the link between the level of concentration and the level of supplier firm performance and profitability components. So I estimate annual cross-sectional regressions where the dependent variable is supplier firm performance, and the main explanatory variable is the level of customer-based concentration. And here is what I find. So there's going to be more coming in this slide. So first of all, after controlling for other firm characteristics and industry effects, I document a positive and significant association between the level of concentration and accounting rates of return. In other words, more concentrated suppliers tend to be more profitable. And that may seem surprising to some. So to understand the link between concentration and performance, I decompose accounting rates of return into asset turnover, which captures asset utilization, and profit margins. And I find that more concentrated suppliers tend to be more profitable because they seem to be better able to utilize their asset base, and they also tend to report higher profit margins. Decomposing profit margins operating and non-operating components, I find that although there are no systematic differences across more and less concentrated suppliers in terms of non-operating margins, more concentrated suppliers tend to be associated with above average operating margins. In other words, operating margins are driving the positive association between the level of concentration and profit margins. Now we can dig further deeper into the problem and decompose operating margin into gross margin minus the ratio of SG&A expenditure to sales. So here's what I find. Consistent with the conventional view, or the Galbraithian view, I find a negative and significant association between concentration and gross margins. So as Galbraith would have expected, more concentrated suppliers tend to be associated with lower gross margins. So at this point, you may be wondering, how can it be the case that more concentrated suppliers tend to report higher operating margins and lower gross margins? Now, this can only happen if they also tend to spend less on SG&A per dollar of sales. Consistent with this claim, the last column documents a negative and significant association between concentration and SG&A ratios. Now, the point here is that the negative association between the level of concentration and SG&A expenditure per dollar of sales is strong enough to outweigh that between concentration and gross margins and induce an overall positive association between concentration, operating margins, and profit margins. Okay? So what's the lesson? What I learned from this table is that although suppliers with more concentrated customer bases tend to experience below average gross margins, they also tend to experience efficiencies that come in two flavors. They tend to be better able to utilize their asset base, as indicated by higher levels of asset turnover, and they tend to spend less on SG&A per dollar of sales. As a result, they report higher operating and profit margins, and overall, they tend to be more profitable. So it seems, even though both the conventional view of concentration and the alternative view have a bite in the data, the alternative view, the view that emphasizes efficiencies, prevails. And that's why I find this positive net effect on performance. Now, the levels analysis provides little basis for inferring causality. However, a cause and effect relationship between customer-based structure and performance implies that the year-by-year changes in concentration should be associated with changes in performance. Now, I take this argument a step further and I argue that efficiencies due to increased information sharing and coordination along the supply chain may only take time to materialize and flow through the financial reporting system of the supplier firm. So I argue that a cause and effect relationship implies a lead-lag association and intertemporal association between the changes in concentration and changes in performance. And that's exactly what I test. So now I'm trying to forecast 1 year ahead changes in performance and performance components based on the contemporaneous year-by-year changes in concentration, right? So the dependent variable is, you can think of this as 1 year ahead changes supply firm performance, and the main independent variable is the delta CC, which is the year-by-year change in concentration, and of course I control for variables that are known to have predictive power. And that's what I find. So after controlling for other predictors and industry effects, I find that delta CC, or the year-by-year change in concentration, have significant implications for subsequent changes in profitability components and overall firm performance. So what I find is that increases in concentration are subsequently followed by efficiency gains in the form of increased asset turnover and reduced SG&A expenditure per dollar of sales, as we would have expected if there was a causal link. Not that this evidence really establishes causality, but it is consistent with the existence of a cause and effect relationship. So in other words, year-by-year change in concentration embeds significant and incremental information about subsequent change in performance and performance components. So given that as an econometrician, I can do a better job predicting subsequent changes in earnings using the information embedded in the customer-based structure of the firm, the question that popped in my mind is whether and how investors use this information when setting stock prices. To examine the link between a customer-based structure and a valuation, what I do is I associate the year-by-year change in concentration with long window stock returns. So I run cross-sectional regressions where now the dependent variable is the long window stock return of the firm, and I try to explain cross-sectional variation based on the year-by-year changes in concentration after controlling for variables that are known to have explanatory power in the cross-section. I find a positive and significant association between the changes in concentration and stock returns, even after controlling for proxies for revenue and expense surprises for the level of earnings and changes in profitability components and, of course, industry effects. So the positive sign of the association implies that investors seem to be revising their valuation consistent with the fundamental information embedded in customer-based concentration changes. So it implies, the sign implies that increases in concentration are good news for stock market valuation and decreases are bad news for stock market valuation. And that this information is sort of incremental to other pieces of information, to earnings and profitability components. Now, this evidence doesn't really address the question, even though it provides some evidence that the market does understand the link between customer-based structure and performance, it doesn't really address the question of whether investors are fully attentive to these implications. So to answer this question, I next try to sort of predict future returns based on the year-by-year changes in concentration. The idea here is that if investors are not fully attentive to inter-firm links and the link between customer-based structure and performance, then it should be the case that when the predictable portion of fundamentals, the portion of fundamentals that could have been predicted based on past changes in concentration is being realized, they will be systematically surprised, and that will show up in future returns. So this is the finding. The finding here is that delta SSE is a significant leading indicator of future returns. And that statement holds even after controlling for size, book to market, and other accounting-based effects. So in combination, my evidence, the stock return analysis, implies or suggests that although stock prices seem to be reacting to the year-by-year changes in concentration, seem to be reacting in a very consistent way to the fundamental information embedding those changes as established in the first part of my paper, prices seem to continue to drift in the direction of the initial change over the subsequent year. Now, a careful examination of alternative hypotheses makes it hard to reconcile the drift based on the delta SSE with the pricing risk in efficient markets. And in fact, the evidence suggests that mispricing caused by investors' underreaction to the link between customer-based structure and performance is a plausible explanation. Consistent with this story, I find that the disproportionate fraction of my effect is sort of clustered around subsequent earnings announcement dates, and that this effect seems to be varying in a very predictable way. It tends to be stronger among stocks that are a priori more likely to be mispriced, such as stocks with low analyst coverage and low institutional ownership. I think I'm going to finish earlier than I expected. That's always good news. All right. You can think of my paper as the first large sample comprehensive investigation of the link between customer-based structure, performance, and valuation. Collectively, and there is more in the paper than what I present here, my evidence suggests that major customer disclosures are important for financial statement analysis. And that is really important when we try to forecast earnings or when we try to explain cross-sectional variation in the level of earnings or profitability, that we look outside the boundaries of the firm and along the supply chain. Okay? So bottom line, it seems that customer-based structure is important and that efficiencies from coordination along the supply chain may prevail the negatives from dealing with major customers. Now, at the conceptual level, I would like also to point out that as academicians and practitioners, we need to probe deeper into the importance of costs that are incurred below the gross margin line. These costs tend to be very important. If I were to focus only on gross margins in my paper, I would probably reach different conclusions with respect to the impact of major customers on supplier firm performance. Okay, thank you very much.
Questions? Repeat the questions, please.
Questions?
Have you looked at negative versus positive changes? I mean, being dropped by a big customer may not mean the same thing as, increasing the investment concentration.
So the question is whether I've looked at separately at positive and negative changes in concentration. And the idea is that there may be an asymmetric effect. As a robustness checks, I've looked at that, but I don't really find an asymmetric effect. And I didn't have an ex-ante prediction as to why the effect would be asymmetric, but empirically I don't recommend an asymmetry.
If you get dropped by a big customer, it means something different than, right? I mean, would that suggest that your SG&A is going to go up as a percentage of sales? I mean, it's kind of hard to, see it more symmetrically.
Yeah, but I have the empirical answer to this, which is it seems to be there are two types of extreme events that could happen. One would be the loss of a major customer. The other extreme event could be the acquisition of a major customer. So on an ex-ante, point of view, I don't really know which one is more dramatic than the other, because an increase in concentration could come from the acquisition of a major customer, and decrease in concentration could come from the loss of a major customer. And both events are dramatic, and both events will fall in the tails or in a cross-sectional sense of the year-by-year change in concentration. Well, that's a good point. Other questions? Yes?
Just following up on that, I wanted to ask about sales in general, because in your customer concentration, it looks like at the 95th percentile, you've got 45%, which seems to me that would be a very different situation than having 12% of your sales concentrated. I want to know, did you look piecewise at how the performance of your model?
I haven't done the piecewise analysis, but to sort of address the impact of non-linearities in my estimations, I've repeated the entire analysis using the scale decile ranks of the regressors, or the scale quintile ranks of the regressors, and I find similar results. So even though to really address your question, I need to do the quintile regression or the decile regression, which I haven't done, but it seems that if there is a non-linearity, it doesn't seem to be dramatically affecting my estimation. But I completely agree with you that extreme levels of concentration may have different implications from moderate levels of concentration. Yeah.
Can you speak briefly to the matching process that you use to match up the suppliers and the customers? You have 26,000 firm years, and it says you manually inspected each for accuracy.
So I have the detailed description in the paper. We can go through that in the break. Yes?
So, given this is about forecasting, how would you take your results and what would it indicate to you if you were actually going to think about building a forecast model as opposed to some historical analysis?
I'm not sure. But, and that's a point I think that Stephen mentioned when I talked to him, that, the accounting of, different line items may have important implications as to what falls, under gross margin or under SG&A, or, how I don't really measure economic performance. I measure accounting performance, and the way we do accounting, sure enough, it has, it affects my estimation. But I don't know in which way. I have to think about that.
Well, I think you're be careful about your inference about get more profitable on the period cost, because you do it in cross section after you've got the customers. Okay, a few years back, you actually spent a lot to actually get the customers. So it's a question whether sort of over the investment in getting the customer. You look at the payoff to the investment. The accounting is working, but that investment's not put on the balance sheet and amortized. It's expensed immediately. When you get a change in customers, you change variable, you're investing more. You hurt the earnings, and then you get the payback later. So of course, almost mechanically, it would increase the profitability.
Right.
Because the way the accounting's working.
But that's accounting profitability. If I were able to measure economic profitability, probably nothing would change, because
Well, we can't do that, that's for sure.
because the investment in customer relationships and major customers, while they were building the relationship, they were spending money, and the accounting is conservative, and we don't really recognize capitalized as investment, right? So my calculation of return on assets would have been affected had it been the case that the investment on customer relationships would have been capitalized when incurred, right? Yes?
Do you view customer concentration as reflecting firm-specific risk?
Repeat the question, please.
So the question was whether customer concentration captures risk. I hate to say I have a working paper on that. And that's basically how I started, because if you go back to the disclosure, to the FASB requirements and the SEC requirements, and the way they justify firms, the requirement to disclose this kind of information is that major customers represent a significant concentration of risk that investors need to know about it, right? So, of course, the question is, what's the empirical link of between concentration and risk? And empirically, the link is very weak. So it is true that suppliers with more concentrated customer bases tend to be smaller firms, and smaller firms tend to be riskier. but once you control properly for other firm characteristics, the link between concentration and risk is non-existent. And that may have to do with probably the fact that the matches between customers and suppliers are not random, right? So even though traditionally you would think that having many customers, you would diversify risk, and probably a firm with a diversified customer base would be less risky, that may not be true because the matching is not random. Small supplier firms tend to be paired with larger customers that are financially healthy. So even though I see your point empirically, it seems not to be working quite right.